Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to go to the ETFs that invest in the Swiss mid-caps in this part 3 of the series of ETFs that invest their money in Swiss companies with dividend distributions. So in total I have 12 ETFs to go over. I already talked about 6. So 3 that invest their money in the SMI, 3 that invest their money in the SLI index, and today I'm going to talk about 2 ETFs that invests their money in either the SMIM, the Swiss Market Index Mid, and that index contains the 30 largest companies on the 6 after the other 20 that make up the SMI. So it's company number 21 up to number 50 that is in this list. And on the other hand, we have the SPI Mid index, and that contains all the mid caps that are on the Swiss Stock Exchange. So it's the 110 largest stocks minus the 30 stocks that are comprised in the SLI index. So it's actually number 31, so the 31st largest company up to the 110th in the rank of largest companies on the SIX stock exchange. So in total 80 stocks are in this list, and important to know is then if you want to invest in the first 50 stocks of the Swiss stock exchange, then you have to go for an ETF that invests its money in the SMI and also for an ETF that invests its money in the SMIM. So when you combine 2 ETFs like that, you have the first 50 stocks on the Swiss stock exchange. And if you want to invest in the first 110 companies of the Swiss stock exchange, you have to go for an ETF that invests its money in the SLI index and accompany that ETF with a SPI Mid ETF. So that's important that you know that. And which are then the most important ones, which make a difference between the two. So of course, the the 50 stocks that come behind the 30. In fact, I should say 60 because these 10 are in the SMIM index, but they are not anymore in the 80 stocks. So these are the first 10 companies that are in the SMIM index, and they are in the SLI index as well as the last 10 biggest ones of the SLI index, but they are not in the SPI Mid index. So that's important that you know that you don't invest your money in the Swatch group, that you don't invest your money in Roche, that you don't invest your money in SGS. So important. So the first one, it's the one that invests its money in the SMIM index, and it's an iShares one, again with a high total expense ratio of 0.45%. I really don't like it that BlackRock is putting up high numbers here. Normally they are price breakers, but in this case they are actually the opposite of it. So in the previous video they had 0.51 as their total expense ratio, and now it's 0.45. So definitely not a fan of that. It's momentarily, so it was on Monday the 18th of December 2023 that it costs 272.30 Swiss francs, and it has almost a bit over 1 billion invested in it. And as you can see, this was suffering a lot. So the SMIM was hit quite hard the past 3 years with the COVID pandemic, which caused the crash, and it's especially these 30 stocks that got hit the hardest. I don't know why, but you can see it also in the next ETF that I'm going to show. It has also performed less, and it has to do with the 20 stocks. So the 20 smallest stocks from the 30 where the SMIM is invested in, they underperformed really the market. But if you look at it from 2004, it has a positive performance of 321%, which is the highest one that I can actually mention when I would have mentioned it with all the ETFs. But yeah, that's the difference between periods where some stocks are underperforming the market, and in 2004 up to 2008 they were uh, totally overperforming, and they didn't got hit that big in the crash of 2008. So yeah, it makes a huge difference. So it gives 7 dividends per year, and that's also actually 4 months where it pays its dividend in. So sometimes you will see on just ETF, for example, you will see that they say that it pays out quarterly. It's not totally correct because it only pays out in 3 quarters. So the first quarter, the second quarter, and then the third quarter of the year. So no dividends in the fourth quarter, but still it are really nice dividends, and with 2.48% dividend yield compared to the cost right now, it's definitely not that bad. Then we have the SPI Mid index that the ETF from UBS is following, with a total expense ratio of 0.25%. That's way better than the one from iShares, of course. And it cost 112.86 Swiss francs. It invests so in the 80 stocks that are in the SPI Mid index, and only 370 million invested in this ETF. And over a 5-year period, it performed more or less well, so 41.32%. And yeah, it's more or less 6-7% less than the SLI index that I mentioned in the previous video. So there the ETFs had 51 up to 45% of performance on 5 years. So that's again, it has to do with those 20 stocks that were underperforming the market. But on 3 years, the effect, it's still there, but it's at least not negative. So instead of 12-15%, it's here 6.5%. And sadly enough, UBS, the most of the ETFs from UBS pay only out 1 or 2 dividends in a year. Most of them, when they give 2, it's in February and August that they are being paid out. But this one, it's an exception for the Swiss dividends from Swiss dividend ETFs from UBS, because it only pays out one time in September, and it has a nice dividend yield, so a bit higher than the previous one, and it's 0.31 plus 2.59 on the 8th of September. So it's not bad at all, but only one dividend in a year, and one dividend date in the year, and that's really a pity. And as you can see as well, so as those 20 stocks that are in the SMIM and also in the SMI Mid, they totally underperformed, and they are also on the bottom of this overview. So this one, it was the other X-Trackers fund from the first video of this series that tracked the SMI, and you know that that fund totally underperformed the other 2 ETFs. So not that bad, but I don't know whether or not I would invest in these. I would rather go for the ETFs that I'm going to discuss in the next video, or the ones that invest in the SMI and the SLI, and not really for the mid caps. It's also a thing. So when you have an index that compromises the companies that are in between, so you have the small caps, then they go to the mid caps, and then they go over to the large caps. So those mid caps, you take them with you in this index when they enter it, and then when they exit it to up to the bigger index. So okay, you take with you a big rise sometimes, but when a stock falls down from the SMI SLI index and it falls down into the mid cap index, you take a long way down with those stocks as well. So I'm always hesitant to invest in mid cap ETFs, and that's not only for Swiss stocks, but also for global funds, for European funds. So I'm not a big fan of mid cap ETFs. And with that being said, thank you for watching and see you on the next video on my YouTube channel. Bye.